Hello and welcome. In this course, we will explore statements of cash flows based on International Accounting Standard 7. IAS 7, titled Statement of Cash Flows, was adopted by the International Accounting Standards Board in April 2001. This standard replaced the previously issued IAS 7, which was known as Statement of Changes in Financial Position and had been issued in October 1977 by the International Accounting Standards Committee. The update to IAS 7 reflected changes in terminology throughout the IFRS standards, which were influenced by the introduction of IAS 1, Presentation of Financial Statements, in 2007. These changes resulted in the updated title, Statement of Cash Flows, aligning with the new IFRS terminology. In January 2016, IAS 7 was amended as part of the Disclosure Initiative, which introduced amendments requiring entities to disclose changes in liabilities that arise from financing activities. Later, in May 2023, the IASB issued further amendments under Supplier Finance Arrangements to IAS 7 and IFRS 7, mandating additional disclosures related to supplier finance arrangements. Over time, several other standards have made minor amendments to IAS 7. These include IFRS 10 on consolidated financial statements, issued in May 2011, IFRS 11 on joint arrangements, also issued in May 2011, amendments related to investment entities to IFRS 10, IFRS 12, and IAS 27, issued in October 2012, IFRS 16 on leases, issued in January 2016, and IFRS 17 on insurance contracts, issued in May 2017. International Accounting Standard 7, also known as the Statement of Cash Flows, IAS 7, consists of 61 paragraphs. All these paragraphs hold equal authority, though they maintain the original format of the standard when it was adopted by the IASB. IAS 7 should be interpreted in the context of its objectives and the basis for conclusions, as well as the preface to IFRS standards and the conceptual framework for financial reporting. Additionally, IAS 8, which covers accounting policies, changes in accounting estimates, and errors, provides guidance on selecting and applying accounting policies when there is no explicit direction given in the standards. The objective of IAS 7 is to provide information about an entity's cash flows, which is crucial for users of financial statements to assess the entity's ability to generate cash and cash equivalents, as well as its needs to utilize those flows. The economic decisions made by users depend on evaluating not only the entity's capacity to generate cash, but also the timing and certainty of that cash generation. This standard aims to ensure that entities disclose information about the historical changes in their cash and cash equivalents through a statement of cash flows. This statement classifies cash flows during the period into 3 categories: operating activities, investing activities, and financing activities. The scope of IAS 7 requires an entity to prepare a statement of cash flows in line with the provisions of the standard and present it as an integral part of its financial statements for each reporting period. This means that the statement of cash flows must be included alongside other financial statements, such as the income statement and balance sheet, for every period the financial statements are prepared. Additionally, this standard replaces the previous IAS 7, which was titled Statement of Changes in Financial Position, and was approved in July 1977. Users of an entity's financial statements are keen to understand how the entity generates and utilizes cash and cash equivalents. This interest remains consistent regardless of the nature of the entity's activities, whether or not cash is the primary product of the entity, as seen with financial institutions. Despite the differences in their core revenue-generating activities, all entities require cash for similar purposes: to operate, meet their obligations, and provide returns to investors. As a result, this standard mandates that all entities present a statement of cash flows to provide this crucial information. The statement of cash flows, when used alongside the other financial statements, provides valuable information that helps users assess changes in an entity's net assets, its financial structure, including liquidity and solvency, and its ability to influence the amounts and timing of cash flows. This information is crucial for adapting to evolving circumstances and seizing new opportunities. Cash flow data is particularly useful in evaluating an entity's capacity to generate cash and cash equivalents. It allows users to build models to assess and compare the present value of future cash flows across different entities. Additionally, cash flow information enhances comparability in reporting operating performance by eliminating the effects of varying accounting treatments for the same transactions and events. Historical cash flow information is frequently used as a reliable indicator of the amount, timing, and certainty of future cash flows. It provides valuable insights into the accuracy of previous forecasts regarding future cash flows and helps assess how well past predictions align with actual outcomes. Additionally, it is useful for examining the relationship between an entity's profitability and its net cash flow, as well as understanding the impact of changing prices on these cash flows. The following terms are defined as specified in this standard. Cash refers to cash on hand and demand deposits. Cash equivalents are short-term, highly liquid investments that are easily convertible into known amounts of cash and carry an insignificant risk of changes in value. Cash flows refer to the inflows and outflows of cash and cash equivalents. Operating activities refer to the main revenue-generating activities of an entity, as well as other activities that do not fall under investing or financing categories. Investing activities involve the acquisition and disposal of long-term assets and other investments that are not classified as cash equivalents. Financing activities encompass actions that lead to changes in the size and composition of the entity's contributed equity and borrowings. Cash equivalents are primarily held to meet short-term cash obligations rather than for investment or other purposes. To qualify as a cash equivalent, an investment must be easily convertible into a known amount of cash and carry a minimal risk of value fluctuations. Typically, an investment qualifies as a cash equivalent if it has a short maturity, usually 3 months or less from the acquisition date. Equity investments are generally excluded from cash equivalents unless they are, in substance, considered cash equivalents. An example would be preferred shares acquired shortly before their maturity, with a specific redemption date. Bank borrowings are typically classified as financing activities. However, in some countries, bank overdrafts that are repayable on demand may form an essential part of an entity's cash management. In these cases, bank overdrafts are included as part of cash and cash equivalents. A key feature of such arrangements is that the bank balance may fluctuate between positive and overdrawn amounts. Cash flows do not include movements between items that make up cash or cash equivalents because these are considered part of an entity's cash management rather than its operating, investing, or financing activities. Cash management involves activities such as investing excess cash in cash equivalents. The statement of cash flows must report cash flows during the period, categorized into operating, investing, and financing activities. An entity should present its cash flows from these activities in a way that is most suitable for its business. The classification by activity provides users with valuable information that helps them assess how these activities affect the entity's financial position, as well as the amount of its cash and cash equivalents. Additionally, this information can be used to evaluate the relationships between the different activities. A single transaction may involve cash flows that are classified under different categories. For instance, when a loan is repaid in cash, the repayment typically includes both interest and principal capital. In such cases, the interest portion is classified as an operating activity, while the principal capital portion is classified as a financing activity. This distinction ensures that each component of the cash flow is categorized according to its nature and purpose. The cash flows arising from operating activities are a crucial indicator of how well the operations of an entity generate enough cash to repay loans, maintain its operational capabilities, pay dividends, and make new investments, all without relying on external financing sources. Understanding the specific components of historical operating cash flows, along with other relevant information, is valuable for forecasting future operating cash flows. This helps users assess the sustainability and financial health of the entity's core operations. Cash flows from operating activities primarily stem from the main revenue-generating activities of the entity and typically arise from transactions and events that contribute to the determination of profit or loss. These cash flows include receipts from the sale of goods and services, as well as cash receipts from royalties, fees, commissions, and other forms of revenue. Additionally, they include cash payments made to suppliers for goods and services, as well as payments to and on behalf of employees. Cash payments or refunds of income taxes are also part of operating activities, unless they can be specifically identified with financing or investing activities. Lastly, cash flows related to contracts held for dealing or trading purposes are included as operating cash flows. Certain transactions, such as the sale of an item of plant, may result in a gain or loss that is included in the recognized profit or loss. However, the cash flows associated with these transactions are classified as cash flows from investing activities. On the other hand, cash payments made to manufacture or acquire assets that are held for rental to others and later intended for sale, such as plant and equipment, are classified as cash flows from operating activities. Similarly, the cash receipts from rents and the subsequent sales of these assets are also considered cash flows from operating activities. An entity may hold securities and loans for dealing or trading purposes, in which case they are treated similarly to inventory acquired specifically for resale. As a result, cash flows from the purchase and sale of dealing or trading securities are classified as operating activities. Likewise, cash advances and loans provided by financial institutions are typically classified as operating activities as they relate to the entity's primary revenue-generating activities. This classification reflects the role of these transactions in the entity's core business operations. Investing activities involve cash flows that reflect the extent to which resources have been allocated to generate future income and cash flows. Only expenditures that result in recognized assets in the statement of financial position are classified as investing activities. Examples of cash flows from investing activities include payments made to acquire property, plant and equipment, intangible assets, and other long-term assets, including those related to capitalized development costs and self-constructed assets. Additionally, cash receipts from the sale of these assets are classified as investing activities. Cash payments made to acquire equity or debt instruments of other entities and interests in joint ventures are classified as investing activities, except when these payments relate to instruments considered to be cash equivalents or those held for dealing or trading purposes. Likewise, cash receipts from the sale of equity or debt instruments of other entities and interests in joint ventures are also categorized as investing activities, unless the receipts involve instruments considered to be cash equivalents or those held for dealing or trading purposes. These cash flows reflect investments made by the entity for the purpose of generating future returns. Cash advances and loans made to other parties, excluding those made by a financial institution, are classified as investing activities. Similarly, cash receipts from the repayment of these advances and loans are also considered investing activities, except when they involve financial institutions. Additionally, cash payments for futures contracts, forward contracts, option contracts, and swap contracts are classified as investing activities, unless these contracts are held for dealing or trading purposes, or the payments fall under financing activities. These transactions represent the entity's investment in financial instruments or resources aimed at generating future cash flows. Cash payments and receipts from futures contracts, forward contracts, option contracts, and swap contracts are categorized as investing activities unless the contracts are held for dealing or trading purposes or unless they fall under financing activities. If a contract is used as a hedge for an identifiable position, the cash flows associated with the contract are classified in the same manner as those of the position being hedged. Financing activities are crucial in understanding the claims that providers of capital, such as equity investors and creditors, have on an entity's future cash flows. These activities include cash proceeds from issuing shares or other equity instruments which represent the entity raising capital from shareholders. Cash payments to owners to acquire or redeem the entity's shares are also part of financing activities, as they reflect returns to investors. Similarly, cash proceeds from issuing debentures, loans, notes, bonds, mortgages, and other borrowings are financing activities, as they involve the entity obtaining funds through debt. Cash repayments of amounts borrowed and cash payments by a lessee for reducing outstanding liabilities related to leases are also classified as financing activities, as they reflect the management of the entity's financial obligations. An entity has the option to report cash flows from operating activities using either the direct or indirect method. The direct method requires the entity to disclose major classes of gross cash receipts and payments, providing a detailed view of cash inflows and outflows from operating activities. On the other hand, the indirect method starts with the profit or loss and adjusts it for non-cash transactions, deferrals or accruals of past or future operating cash receipts or payments, and income or expense items related to investing or financing activities. While both methods are permitted, the direct method offers more detailed information about cash flows, while the indirect method focuses on adjustments to profit or loss and is often preferred for its simplicity. Entities are encouraged to use the direct method for reporting cash flows from operating activities because it provides useful information that can help in estimating future cash flows, which is not available through the indirect method. Under the direct method, an entity can obtain information about major classes of gross cash receipts and payments either from its accounting records or by adjusting figures such as sales, cost of sales, including interest and similar income and expense for financial institutions, and other items in the statement of comprehensive income. The adjustments are made for changes during the period in inventories, operating receivables, and payables, as well as other non-cash items and items where the cash effects are related to investing or financing activities. Under the indirect method, the net cash flow from operating activities is determined by adjusting the profit or loss for various factors. These adjustments include changes in inventories, operating receivables, and payables during the period. Non-cash items such as depreciation, provisions, deferred taxes, unrealized foreign currency gains and losses, and undistributed profits of associates are also considered in the adjustments. Additionally, all other items with cash effects related to investing or financing activities are taken into account. Alternatively, the net cash flow from operating activities may be presented by showing the revenues and expenses disclosed in the statement of comprehensive income, along with the changes in inventories, operating receivables, and payables during the period. An entity is required to report separately the major classes of gross cash receipts and gross cash payments arising from investing and financing activities. However, cash flows can be reported on a net basis in certain circumstances where it is appropriate to do so. This ensures transparency and allows users to better assess the entity's cash flows related to these activities while providing clarity on the impact of investing and financing decisions on the entity's overall financial position. Cash flows can be reported on a net basis for certain activities where it is appropriate. This includes cash receipts and payments on behalf of customers when those cash flows primarily reflect the activities of the customer rather than those of the entity. Additionally, cash receipts and payments for items that have quick turnover, large amounts, and short maturities may also be reported on a net basis. This approach simplifies reporting and provides a clearer picture of the entity's actual cash flows in such circumstances. Examples of cash receipts and payments that may be reported on a net basis include the acceptance and repayment of demand deposits by a bank, funds held for customers by an investment entity, and rents collected on behalf of property owners and paid over to them. These transactions involve the entity acting as an intermediary, and the net basis provides a clearer representation of the actual cash flows related to the entity's operations, excluding those passed through to others. Examples of cash receipts and payments that may be reported on a net basis include advances made for and the repayment of principal amounts relating to credit card customers, the purchase and sale of investments, and other short-term borrowings, such as those with a maturity period of 3 months or less. These transactions typically involve quick turnover and short-term maturities, making the net reporting method appropriate to reflect the entity's actual cash flows more accurately. Cash flows arising from each of the following activities of a financial institution may be reported on a net basis: cash receipts and payments for the acceptance and repayment of deposits with a fixed maturity date, the placement of deposits with and withdrawal of deposits from other financial institutions, and cash advances and loans made to customers, as well as the repayment of those advances and loans. These activities are typically part of the day-to-day operations of a financial institution, and reporting them on a net basis provides a clearer picture of the cash flows directly impacting the institution's liquidity. Cash flows arising from transactions in a foreign currency must be recorded in an entity's functional currency by applying the exchange rate between the functional currency and the foreign currency at the date of the cash flow. For the cash flows of a foreign subsidiary, these should be translated at the exchange rates between the functional currency and the foreign currency at the dates of the cash flows. This ensures that foreign currency transactions are accurately reflected in the financial statements in the functional currency, providing a clearer picture of the entity's cash movements. Cash flows denominated in a foreign currency are reported in a manner consistent with IAS 21, the effects of changes in foreign exchange rates. This allows for the use of an exchange rate that approximates the actual rate, such as using a weighted average exchange rate for a period when recording foreign currency transactions or translating the cash flows of a foreign subsidiary. However, IAS 21 does not permit the use of the exchange rate at the end of the reporting period when translating the cash flows of a foreign subsidiary. This ensures that foreign currency fluctuations are accurately reflected in the financial statements, maintaining consistency with the entity's functional currency. Unrealized gains and losses arising from changes in foreign currency exchange rates are not considered cash flows. However, the effect of exchange rate changes on cash and cash equivalents held or due in a foreign currency is reported separately in the statement of cash flows. This helps to reconcile the cash and cash equivalents at the beginning and the end of the period. This amount is presented separately from cash flows related to operating, investing, and financing activities. It reflects the differences, if any, that would have occurred if those cash flows had been reported at the exchange rates at the end of the period. Cash flows from interest and dividends received and paid must be disclosed separately in the statement of cash flows. Each type of cash flow should be classified consistently from period to period as either operating, investing, or financing activities. Additionally, the total amount of interest paid during a period must be disclosed in the statement of cash flows, whether it has been recognized as an expense in profit or loss or capitalized in accordance with IAS 23, which covers borrowing costs. For financial institutions, interest paid and interest and dividends received are typically classified as operating cash flows. However, for other entities, there is no universal agreement on their classification. These cash flows may be considered operating activities because they contribute to the determination of profit or loss. Alternatively, interest paid may be classified as a financing activity, as it represents the cost of obtaining financial resources, while interest and dividends received may be classified as investing activities, as they represent returns on investments. Dividends paid are generally classified as financing cash flows since they represent a cost of obtaining financial resources. However, they may also be classified as operating cash flows to help users assess an entity's ability to pay dividends from its operating cash flows. The classification should be applied consistently across reporting periods. Cash flows arising from taxes on income must be disclosed separately and are generally classified as operating cash flows. However, if these tax payments or receipts can be directly linked to financing or investing activities, they should be classified accordingly. Taxes on income arise from transactions that generate cash flows classified under operating, investing, or financing activities. While tax expenses may be directly linked to investing or financing activities, identifying the related tax cash flows is often impractical, especially when they occur in a different period than the underlying transaction. As a result, taxes paid are generally classified as operating cash flows. However, if it is feasible to directly associate tax cash flows with specific investing or financing transactions, they should be classified accordingly. When tax cash flows are allocated across multiple activities, the total amount of taxes paid must be disclosed separately. When an entity accounts for an investment in a subsidiary, associate, or joint venture using the equity or cost method, it limits its cash flow reporting to transactions directly occurring between itself and the investee, such as dividends and advances. If an entity applies the equity method to report its interest in an associate or joint venture, it includes in its statement of cash flows the cash flows related to its investment, as well as any distributions, payments, or receipts exchanged between itself and the associate or joint venture. The aggregate cash flows arising from obtaining or losing control of subsidiaries or other businesses shall be presented separately and classified as investing activities. An entity shall disclose in aggregate in respect of both obtaining and losing control of subsidiaries or other businesses during the period each of the following: the total consideration paid or received, the portion of the consideration consisting of cash and cash equivalents, the amount of cash and cash equivalents in the subsidiaries or other businesses over which control is obtained or lost, and the amount of the assets and liabilities other than cash or cash equivalents in the subsidiaries or other businesses over which control is obtained or lost, summarized by each major category. An entity that qualifies as an investment entity is not required to apply specific presentation requirements to a subsidiary investment that must be measured at fair value through profit or loss. The separate presentation of the cash flow effects of obtaining or losing control of subsidiaries or other businesses as single-line items, together with the separate disclosure of the amounts of assets and liabilities acquired or disposed of, helps to distinguish those cash flows from the cash flows arising from the other operating, investing, and financing activities. The cash flow effects of losing control are not deducted from those of obtaining control. The aggregate amount of the cash paid or received as consideration for obtaining or losing control of subsidiaries or other businesses is reported in the statement of cash flows net of cash and cash equivalents acquired or disposed of as part of such transactions, events, or changes in circumstances. Cash flows arising from changes in ownership, interests in a subsidiary that do not result in a loss of control shall be classified as cash flows from financing activities unless the subsidiary is held by an investment entity, as defined in IFRS 10, and is required to be measured at fair value through profit or loss. Changes in ownership interests in a subsidiary that do not result in a loss of control, such as the subsequent purchase or sale by a parent of a subsidiary's equity instruments, are accounted for as equity transactions, see IFRS 10, unless the subsidiary is held by an investment entity and is required to be measured at fair value through profit or loss. Accordingly, the resulting cash flows are classified in the same way as other transactions with owners. Investing and financing transactions that do not require the use of cash or cash equivalents should be excluded from the statement of cash flows. However, these transactions must be disclosed elsewhere in the financial statements in a manner that provides all the relevant information regarding these investing and financing activities. Many investing and financing activities do not directly impact current cash flows, although they do affect an entity's capital and asset structure. Excluding non-cash transactions from the statement of cash flows aligns with the objective of the statement, as these items do not involve cash flows in the current period. Examples of non-cash transactions include the acquisition of assets through assuming related liabilities or by means of a lease, the acquisition of an entity through an equity issue, and the conversion of debt to equity. An entity is required to provide disclosures that allow users of the financial statements to assess changes in liabilities arising from financing activities. These disclosures must include both changes resulting from cash flows and non-cash changes. This ensures transparency in understanding the entity's financing activities, including how its liabilities are affected by financial transactions or other events, such as reclassifications, adjustments, or the issuance of debt. An entity shall provide disclosures that enable users of financial statements to evaluate changes in liabilities arising from financing activities, including both changes arising from cash flows and non-cash changes. To the extent necessary to satisfy the requirement, an entity shall disclose the following changes in liabilities arising from financing activities: changes from financing cash flows, changes arising from obtaining or losing control of subsidiaries or other businesses, the effect of changes in foreign exchange rates, changes in fair values, and other changes. Liabilities arising from financing activities are liabilities for which cash flows were, or future cash flows will be, classified in the statement of cash flows as cash flows from financing activities. In addition, the disclosure requirement also applies to changes in financial assets, for example, assets that hedge liabilities arising from financing activities. If cash flows from those financial assets were, or future cash flows will be, included in cash flows from financing activities, One way to fulfill the disclosure requirement is by providing a reconciliation between the opening and closing balances in the statement of financial position for liabilities arising from financing activities, including the changes identified. Where an entity discloses such a reconciliation, it shall provide sufficient information to enable users of the financial statements to link items included in the reconciliation to the statement of financial position and the statement of cash flows. Entity provides the required disclosure in combination with disclosures of changes in other assets and liabilities. It shall disclose the changes in liabilities arising from financing activities separately from changes in those other assets and liabilities. An entity shall disclose information about its supplier finance arrangements that enables users of financial statements to assess the effects of those arrangements on the entity's liabilities and cash flows, and on the entity's exposure to liquidity risk. Supplier finance arrangements are characterized by one or more finance providers offering to pay amounts an entity owes its suppliers and the entity agreeing to pay according to the terms and conditions of the arrangements at the same date as, or a date later than, suppliers are paid. These arrangements provide the entity with extended payment terms or the entity's suppliers with early payment terms compared to the related invoice payment due date. Supplier finance arrangements are often referred to as supply chain finance, payables finance, or reverse factoring arrangements. Arrangements that are solely credit enhancements for the entity, for example, financial guarantees including letters of credit used as guarantees, or instruments used by the entity to settle directly with the supplier the amounts owed, for example, credit cards, are not supplier finance arrangements. To meet the objectives, an entity shall disclose, in aggregate, the terms and conditions of its supplier finance arrangements, including details such as extended payment terms and any security or guarantees provided. If there are arrangements with dissimilar terms and conditions, these should be disclosed separately. As of the beginning and end of the reporting period, the entity must disclose the carrying amounts and associated line items presented in the statement of financial position for the financial liabilities that are part of a supplier finance arrangement, as well as those for which suppliers have already received payment from the finance providers. Additionally, the entity should disclose the range of payment due dates for both the financial liabilities and comparable trade payables not part of a supplier finance arrangement. In cases where these ranges are wide, explanatory information should be provided or additional stratified ranges disclosed. Finally, the entity must report the type and effect of non-cash changes in the carrying amounts of the financial liabilities, such as the impact of business combinations, exchange differences, or other transactions that do not involve cash or cash equivalents. An entity shall disclose the components of cash and cash equivalents and provide a reconciliation between the amounts presented in its statement of cash flows and the corresponding items reported in the statement of financial position. Given the diversity or variety of cash management practices and banking arrangements worldwide, and in compliance with IAS 1 presentation of financial statements, an entity is required to disclose the policy it adopts for determining the composition of cash and cash equivalents. The effect of any change in the policy for determining the components of cash and cash equivalents, such as a change in the classification of financial instruments previously considered part of an entity's investment portfolio, is reported in accordance with IAS 8 accounting policies, changes in accounting estimates, and errors. An entity shall disclose, together with a commentary by management, the amount of significant cash and cash equivalent balances held by the entity that are not available for use by the group. There are various circumstances in which cash and cash equivalent balances held by an entity are not available for use by the group. Examples include cash and cash equivalent balances held by a subsidiary that operates in a country where exchange controls or other legal restrictions apply when the balances are not available for general use by the parent or other subsidiaries. Additional information may be relevant to users in understanding the financial position and liquidity of an entity. Disclosure of this information, together with a commentary by management, is encouraged and may include the amount of undrawn borrowing facilities that may be available for future operating activities and to settle capital commitments, indicating any restrictions on the use of these facilities, the aggregate amount of cash flows that represent increases in operating capacity separately from those cash flows that are required to maintain operating capacity, and the amount of the cash flows arising from the operating, investing, and financing activities of each reportable segment. The separate disclosure of cash flows that represent increases in operating capacity and cash flows that are required to maintain operating capacity is useful in enabling the user to determine whether the entity is investing adequately in the maintenance of its operating capacity. An entity that does not invest adequately in the maintenance of its operating capacity may be prejudicing future profitability for the sake of current liquidity and distributions to owners. The disclosure of segmental cash flows enables users to obtain a better understanding of the relationship between the cash flows of the business as a whole and those of its component parts and the availability and variability of segmental cash flows. This standard becomes operative for financial statements covering periods beginning on or after the 1st of January 1994. IAS 27, as amended in 2008, amended paragraphs 39, 42, and added paragraphs 42A and 42B. An entity shall apply those amendments for annual periods beginning on or after the 1st of July 2009. If an entity applies IAS 27, amended 2008 for an earlier period, the amendments shall be applied for that earlier period. The amendments shall be applied retrospectively. Paragraph 14 was amended by improvements to IFRSs issued in May 2008. An entity shall apply that amendment for annual periods beginning on or after the 1st of January 2009. Earlier application is permitted. If an entity applies the amendment for an earlier period, it shall disclose that fact and apply paragraph 68A of IAS 16. Paragraph 16 was amended by improvements to IFRSs issued in April 2009. An entity shall apply that amendment for annual periods beginning on or after the 1st of January 2010. Earlier application is permitted. If an entity applies the amendment for an earlier period, it shall disclose that fact. IFRS 10 and IFRS 11, joint arrangements issued in May 2011, amended paragraphs 37, 38, and 42B, and deleted paragraph 50B. An entity shall apply those amendments when it applies IFRS 10 and IFRS 11. Investment entities amendments to IFRS 10, IFRS 12, and IAS 27, issued in October 2012, amended paragraphs 42A and 42B and added paragraph 40A. An entity shall apply those amendments for annual periods beginning on or after the 1st of January 2014. Earlier application of investment entities is permitted. If an entity applies those amendments earlier, it shall also apply all amendments included in investment entities at the same time. IFRS 16 leases issued in January 2016 amended paragraphs 17 and 44. An entity shall apply those amendments when it applies IFRS 16. Disclosure Initiative amendments to IAS 7 issued in January 2016 added paragraphs 44A, 44E. An entity shall apply those amendments for annual periods beginning on or after the 1st of January 2017. Earlier application is permitted. When the entity first applies those amendments, it is not required to provide comparative information for preceding periods. IFRS 17, Insurance Contracts issued in May 2017, amended paragraph 14. An entity shall apply that amendment when it applies IFRS 17. Supplier Finance Arrangements issued in May 2023 added paragraphs 44F, 44H. An entity shall apply those amendments for annual reporting periods beginning on or after the 1st of January 2024. Earlier application is permitted. If an entity applies those amendments for an earlier period, it shall disclose that fact. In applying supplier finance arrangements, an entity is not required to disclose comparative information for any reporting periods presented before the beginning of the annual reporting period in which the entity first applies those amendments. Additionally, the entity is not required to disclose the information otherwise required by paragraph 44H BS2 Shari as at the beginning of the annual reporting period in which it first applies those amendments, nor is it required to provide the information otherwise required by paragraphs 44 F 44H for any interim period presented within the annual reporting period in which the entity first applies those amendments. The disclosure initiative was approved for issue by 13 of the 14 members of the International Accounting Standards Board. Mr. Ochi dissented, and his dissenting opinion is set out after the basis for conclusions. The members who approved the amendments were Hans Hugervorst, Ian McIntosh, Stephen Cooper, Philippe Denjou, Martin Edelman, Patrick Finnegan, Amaro Gomes, Gary Kabarek, Suzanne Lloyd, Takatsugu Ochi, Daryl Scott, Chungwoo Su, Mary Tokar, and Weiguo Zhang. Supplier finance arrangements, which amended IAS 7 Statement of Cash Flows and IFRS 7 Financial Instruments Disclosures, was approved for issue by 12 of the 14 members of the International Accounting Standards Board. Mr. Esterer and Ms. Kieran abstained from voting due to their recent appointment to the IASB. The members who approved the amendments were Andreas Barco, Linda Mizon-Hutter, Nick Anderson, Patrina Buchanan, Tadeu Senden, Florian Esterer, Zach Gast, Haggett Karen, Jianqiao Liu, Bruce McKenzie, Bertrand Perrin, Rika Suzuki, Ann Tarka, and Robert Uhl. Thank you for completing our course and for the attention and dedication you've shown throughout. We are happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qlever.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in our future courses.